A home equity line of credit, or HELOC, is a great way to access the equity that you have in your home. It does not change the interest rate on your primary mortgage, which is great if you bought or refinanced when rates were ultra low. That said, the interest rates on HELOCs tend to be on the higher side. So why am I talking about all this? Well, I'm a writer on the mortgages and home ownership team at NerdWallet, and my colleagues and I spend pretty much all our time decoding the ins and outs of stuff like HELOC rates. So today, we are going to talk about how HELOC rates are determined, what makes them vary, and what you can do to get the best possible rate on a HELOC. And to do that, we are going to chat with my colleague, Taylor Getler, who has written a ton about home equity borrowing. All right, Taylor, let's start with the basics. How are HELOC rates determined?
So there's two elements that determine what a HELOC rate is going to be. So the first part is called the prime rate. That's just set across all lenders, most lenders at least, use this rate called the prime rate. And that's the lowest possible rate that they're willing to offer for loans and lines of credit for their most attractive borrowers. Unfortunately, that's not where your rate's going to be. The second part is a margin that they add to that prime rate. So the margin is what's determined by your personal financial profile, your credit score, your debt history, how much you want to borrow, your income, factors like that. So they add that margin to the prime rate, and that's how they calculate what your HELOC rate is going to be.
Now, the prime rate changes when the Federal Reserve raises or lowers interest rates. Does that mean your HELOC rate is always changing too?
Yes, so most HELOC rates are variable, which means that they change over time. And again, remember, HELOCs have very long repayment terms most of the time. We're talking about decades. So it can be really difficult to be able to predict what your payment is going to be like down the road. One way that you can offset some of this risk is by choosing a lender that offers a fixed rate option for their HELOC. But at the same time, most lenders do have a limit on how many times you can lock your rate.
Taylor, what can a borrower do to get a lower HELOC rate?
Lenders typically reserve their lowest HELOC rates for borrowers that have the strongest financial profiles. So some ways that you can really stand out as an applicant is to pay down your debts and raise your credit score. You can also apply with multiple lenders so that you can compare your HELOC rate offers and choose from among the lowest.
Besides looking for the lowest rate, how else can folks keep their HELOC payments manageable?
One thing to keep in mind is that your monthly minimum payment does change over the life of the loan. So in the first 10 years of the loan, when it's the draw period, you're only required to pay interest. But during the second phase of the loan, you're required to pay both interest and principal. If you start paying down principal from the beginning, you can help keep your payments steady over the life of the loan. But if you choose to wait to start paying principal until you're in that second phase of the loan, your payments are going to be a lot higher than they were for those first 10 years.
Wow, so that is a lot to plan for. Thanks so much for detangling it all for us, Taylor.
Of course, thank you for having me.
I'm Kate Wood, and I write about mortgages and home buying for NerdWallet. Head to nerdwallet.com to see the latest HELOC rates and learn more about different HELOC lenders. But while you're here, like and subscribe for more.